Thinking about investing in Mexican real estate? Before you dive in, there are two things you must get right: your immigration status and your tax setup. Getting these things wrong could mean leaving thousands of dollars on the table, dealing with legal headaches, and even struggling to cash out later. But don't worry. Today, I'm breaking it down for you so you can invest smart and keep more money in your pocket. I'm Diani Leal, real estate broker and investment consultant in Puerto Vallarta and Banderas Bay. And this channel is brought to you by Diani Investment Realty, which is brokered by EXP. Before we dive in, please make sure to hit that subscribe button if you haven't yet. It really makes a big difference for entrepreneurs like me to enable me to keep bringing you valuable content on real estate investing in Mexico. I also want to mention that as a broker and investment consultant and investor myself, I'm always looking for opportunities to partner with other investors. I provide services specifically designed for investors, such as property management and project management for remodels and renovations, for example. And I also offer commitment-free consultations for a fee. But also, if you are looking for an investment partner, please don't hesitate to reach out. All of my contact information is in the bio of my channel and also right here on this video description. Today, we're talking about a critical part of investing in Mexican real estate for foreigners that most people overlook: how to set up your immigration and tax status in a way that saves you money and protects your investment. We're going to cover whether you can buy property on a tourist visa. Spoiler alert, you can, but there are some cons. The advantages of permanent residency or even citizenship, how your tax setup can save you thousands when you sell, and an alternative strategy, partnering with a boots on the ground investor. So let's get started. So first things first, immigration setup. Can you buy property on a tourist visa? The answer is yes, you can. But here's the catch. So first of all, there really is no legal requirement because you utilize a trust. And if you're already familiar with the way Mexican real estate works for foreigners, you might already know a little bit about the trust. But I did record an entire video breaking down all the details of the trust, the logistics, the pros, the cons, how it works from a legal perspective, and the security and the benefits that it provides for you directly. So I will plug that video right here in the video description if you want to refer back to that to learn a little bit more about the trust. But right now we're talking about the possibility of purchasing property on a tourist visa. So because you do have the trust, you can buy property without any legal registration in the country. However, if you plan to rent it out or sell it later, you might face higher taxes, legal complications, and banking issues. Here's why. Higher withholding tax on rental income. If you don't have residency, you're considered a non-resident for tax purposes, which means Mexico applies a flat 25% tax on your gross rental income. The key word here is gross, which means you can't deduct any of the expenses like maintenance, HOA fees, or property management costs. If you have temporary or permanent residency, you can register for an RFC, which is a Registro Federal de Contribuyentes, which is a tax identification number. It's basically the equivalent of an EIN in the United States. But not only companies have RFCs in Mexico, individuals can have them as well. In order to obtain a legitimate and documented factura, which is an invoice and also a record of the payment that's officially registered with the tax authorities in Mexico, you will need to provide your RFC. If you don't have an RFC because you're a tourist and you're in Mexico on a tourist visa, you cannot get a factura, which means your investments in the property basically never happen, and there's really no paper trail to prove them. Otherwise, you'd be taxed on your net rental income after deductions, which can significantly reduce your tax bill. Which brings me to my next point. Another downside to purchasing property on a tourist visa is that you can't deduct any of your expenses. So 2, no ability to offset income with deductions. Non-residents pay taxes on total rental income with no deductions. Residents can deduct their operational expenses, reducing their taxable income and their total tax burden. And finally, 3, Airbnb and property management services withhold a higher tax on Airbnb and VRBO, Booking.com, because they are often required to automatically withhold rental taxes, typically at the higher non-resident rate. And finally, the 4th negative part of purchasing property on a tourist visa is your capital gains tax. If you're selling later, you're going to be expecting a bigger tax bill. Non-residents often pay more in capital gains tax when they're selling their property. But with an RFC, you can potentially cut that tax bill in half because you have more allowable deductions. And really, you can just record everything throughout the ownership of your property to just kind of keep chipping away at that capital gains tax bill. But it has to be officially with an RFC. So that's why it's beneficial, not just to get your residency, but to get it as close to the point of purchasing your property as possible. Ideally before, and a lot of times you will need to have your deed or some sort of proof of address to get your RFC, but there's several workarounds for that. So really, one of the first steps you'll want to make is getting your residency so you can then get your RFC. This is very important. Otherwise, you could really be leaving a lot of money on the table. So a lot of people ask, and many people who are in the United States actually do have the eligibility for Mexican citizenship because their parents were born in Mexico or they have some sort of familial connection with the country. And others will just be curious, wanting to know if they have the ability to become a citizen, if that would even be worth it. And truthfully, it really depends on your circumstances. It can be worth it for some people, and for others, it really might not be. So one thing is you can own land in your own name instead of using the bank trust. As we've already discussed in trust videos, using the trust doesn't really have a lot of negative implications, only there's an annual cost to it, and that's about $500 a year. So generally speaking, if this is the only reason you would be getting your citizenship, it might not necessarily be worth it just to save $500 a year. But there's another big perk for investors that citizenship can offer, and that's more streams of financing, available financing. So it just depends if you're going to be utilizing all cash or if you will be considering financing any of your property purchases. Because when you do finance as a citizen, as a Mexican citizen, your down payments are considerably lower. So you might be paying as low as 10, 15% down on a property, which means that's going to increase your cash on cash return. And you can get started with a little bit less cash up front, which can be really beneficial to some investors. So basically open up a whole new stream of potential financing because now you're building credit in Mexico as a Mexican citizen, and also you're building your credit in your home country and working with that as well. However, if you're planning on using all cash and you really don't like to borrow money or deal with interest rates or any of that stuff, then again, it's probably not going to be worth it for you. And finally, one other pretty big perk is, of course, going back to capital gains tax, which is something every investor wants to minimize as much as possible. You will automatically qualify for capital gains tax exemption as a Mexican citizen. Whereas if you're a permanent resident, you can still qualify for the tax exemption, but you do have to prove that you're a fiscal resident, which means the majority of your income comes from Mexico. However, if you're a citizen, you automatically qualify and you don't have to prove that at all. As a foreign investor, you most likely have sources of income from outside of the country, and maybe not all of your income is coming from within Mexico. And so the main things with capital gains tax is you can apply every 3 years for the exemption. And you have to provide 3 years of proof of address with your name on it in a utility bill, such as an energy bill or a phone bill. It needs to be your primary residence, and that's what you're going to have to prove in order to qualify for the exemption. So what's another option? Well, a boots on the ground investment partner can also help you if you're not really ready for residency, you don't spend a lot of time in Mexico, and maybe you're a little bit more focused on a long distance investing strategy and you don't really want to have to go live in Mexico or do the work that's required to get your residency and all of those legal requirements. So this would probably be more preferable for the long distance international investor. So this could be a trusted business partner, a friend in Mexico, a local property manager or real estate agent, many of which have investment properties, know the landscape really well, have citizenship or other legal requirements that are necessary to help facilitate your investment from abroad. And you can always structure this partnership legally and form a legal company, whether it be an LLC in the United States, for example, or a Mexican company, such as a Sociedad Anónima, which is an SA. There are probably a couple of different ways that you could formally structure this partnership. By structuring this collaboration properly, you can potentially bypass some of the legal and tax complications while still earning passive income. Just, of course, make sure your agreements are airtight and work with a good real estate attorney to ensure everything is structured legally, properly, officially, and formally. So what about your tax setup? This is where a lot of people lose money, is not setting up their taxes properly from day one. If you don't set this up right, you could wind up paying 35% in capital gains tax when you sell. But if you register correctly, you could cut that tax bill in half or more. So this is what you need. You need your RFC, and this is going to be your Mexican tax ID, which we already discussed at the beginning of this video. And you get it through SAT, which is the Mexican Tax Authority. And you need at least a temporary residency visa to get it. Why does it matter? Well, with an RFC, you can get tax deductions on properties expenses, as we discussed, reduce your capital gains tax, and legally collect rental income without excessive withholding taxes. Also, if you plan to buy, hold, and sell later, work with a tax professional before you buy to structure things properly from the start. This is really going to help you a lot. So I highly, 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 highly recommend getting an RFC so you don't leave money on the table. And this is extremely easy. A lot of people charge maybe $100 and they'll accompany you to SAT with all of your documents once you get your residency. Another really important detail, and we'll focus on this in another video where I can interview a tax professional, such as a Mexican CPA, that can give us a little bit more information. But there are different ways that you can actually structure your tax status as a real estate investor to ensure that everything is properly documented and you're going to reduce all of your taxes from the beginning. You can also put your tax status on hold while you're not using it, so you don't have to pay taxes all the time, and then you can activate it right before you sell. So there are a lot of different options that you can take with your RFC, but it's really good to have it in your back pocket so you know that you can utilize it if necessary. And the investment that's required to file consistently and make sure everything is updated is really quite low and definitely worth it when it comes to how much you're going to save in the long run. All right, let's wrap this up. So to summarize, yes, you can buy real estate on a tourist visa, but it's not ideal if you plan to rent or sell. Getting residency or even citizenship has major financial and tax benefits. Your tax setup matters. Getting an RFC now can save you thousands in the long run. And finally, if you're not ready for residency, consider working with a boots on the ground partner to make investing easier for you. If you found this helpful, please make sure to let me know in the comments. Let me know if you want me to expand more on any of the topics that we've addressed today, because I know we're barely grazing the surface on how to invest in Mexican real estate securely, safely, and how to maximize your returns. And also, of course, don't forget to subscribe if you haven't yet. Until next time.